Asset is coming out with very interesting NFO, which is Mirae Asset NYSE FANG+ ETF, an open-ended scheme which will be replicating and tracking NYSE FANG+ Total Return Index, and a fund of fund, which is Mirae Asset NYSE FANG+ ETF Fund of Fund, which is an open-ended fund of fund scheme predominantly investing in Mirae Asset NYSE FANG+ ETF. So basically, we are coming out with two offerings. One is an ETF, which will be directly investing in underlying stocks forming part of NYSE FANG+Index, and a fund of fund, which will be investing in the ETF itself. The idea behind launching these two products is to provide two investment vehicles which investor can use based on his or her requirement to take exposure in the NYSE FANG+Index. So an investor who wants to buy an ETF, who wants to hold the ETF unit in his or her demat account, who wants to invest in the ETF at intraday pricing level, can invest in Mirae Asset NYSE FANG+ ETF. Whereas an investor who just want to take a simple mutual fund route and want to invest in the portfolio based on day close NAV, and let's say wants to do SIP, etc., can invest in Mirae Asset NYSE FANG+ ETF Fund of Fund. So both the schemes provide two very different vehicles for investment, and each of them is suitable to a different type of investor depending on his or her requirement. Before I go into any further detail, let me first talk about why investors should now seriously think about global investing. Indian equity market is only 3% of the global equity market in terms of market cap. And our equity market is dominated by traditional sectors like banks, oil and gas, IT consultancy, etc. Whereas we now know that there are a lot of innovative things which are happening in the world. There are a lot of mega trends which are changing the way we live in. There are a lot of innovative technologies which are getting invented every year, and we are talking about things like cloud computing, e-commerce, social media, electric vehicles, which either have already changed the world we live in or are going to change the way we are going to live in future. And if investor wants to take exposure in such sort of companies, he or she needs to look outside India for getting that exposure, because as of now, such companies are not present in Indian equity markets. And that is why it becomes a necessity in a way to look outside or look outwards. That is one reason. The second reason is that different geographies perform in different years. There are periods when Indian markets have performed well compared to US, compared to China, compared to Europe. But there are several years where US has done well and far outperformed markets like India. So it is necessary for investors to explore these opportunities, because these can be different avenues of wealth creation. Also, one very interesting thing is when a person invests in a foreign market, the depreciation of local currency, or rather the depreciation of INR, adds to his or her returns. Because when you are investing in foreign asset, you are converting INR to, let's say, USD, and when you are redeeming, you are again going to reconvert the USD into INR. And in case of depreciation of INR, the concerned depreciation will add into your returns. For example, since 2009, the INR has depreciated by roughly around 2.3% on an annual basis, and this would have added to your returns. One also interesting thing which happens is that global equity markets like US, like Europe, are very less correlated with the Indian markets. While it is positively correlated, which means that it somewhat tends to move in a similar direction, but that correlation is weak. Now, what happens in that case is if you are invested in multiple markets which have weak correlation, your diversification has improved and your risk profile of the portfolio reduces because you have diversified across multiple geographies. So just to summarize on why investors should think about investing in global markets, the first one is different markets perform in different years, and hence by participating in multiple geographies you can get returns from different geographies in different year depending on their performance. Since the markets are weakly correlated, your overall portfolio becomes more diversified and risk is reduced. And also you can get additional returns because of the depreciation of the local currency. Now we are coming out with a very interesting product which is based on NYSE FANG+Index. Now, what is NYSE FANG+Index? NYSE FANG+Index is an equal weighted index which is designed to represent a segment of technology and consumer discretionary sectors consisting of highly traded growth stocks. In a nutshell, it will consist of tech, internet, and media companies which are exhibiting high growth characteristics and which are leaders in their respective domain and are leading or are at the forefront of several mega trends. Currently, this portfolio consists of very well-known companies like Facebook, Amazon, Apple, Netflix, Alphabet, also known as Google, Tesla, Nvidia, Alibaba, and Baidu. And all these stocks have equal weight, and this equal weight is reset on a quarterly basis, and in between the quarters, depending on the performance and price movement, these stocks can move from their equal weight. Now these FANG plus companies are very well known to us. They form part of our daily life. In fact, companies like Apple, Google, Facebook, Netflix, all these have become so much part of our daily life that maybe we cannot imagine living without it. And these companies are capturing the current mega trends like e-commerce, internet surfing, streaming, gaming, social media, cloud computing, electric vehicles, data centers, automation, etc. And because these are involved in these mega trends which are changing the world we live in, which is changing the way businesses are run, which is changing our society also, these are generating multiple revenue streams. These are generating products and services which are disrupting the economy and creating huge revenues and earnings for these companies either now or they are expected to do so in near future. And while these companies are leading these mega trends right now, they are not just sitting on the innovations which they have already done. These companies are pouring money in more innovative services and products. In fact, these companies in 2018 have invested around $68 billion in just research and development. These companies also have acquired more than 1,000 companies in total across their lifetime, totaling to almost $176 billion. So these companies are not only growing organically, but they are also growing inorganically. And the way these companies are, not only they have transformed the way we live in, they have transformed our past, but they are working to continue causing these disruptions, bringing out new products and services which are going to change the way we live in future also. And that is why these companies are not just about today. These companies are also about future. And from a long-term point of view, we expect these companies to possibly continue creating more innovative products and services. And that is why this portfolio is such an appealing portfolio if any investors want to take exposure in these well-known FANG Plus companies. From a size point of view, while the portfolio itself is only 10 stock based, just imagine that these 10 stocks in terms of the total MCAP of these companies are $7.7 trillion, which is more than 2 times the size of India's GDP. The revenue of these companies put together is $1.1 trillion, which is 3 times the size of Indian government's total receipt in FY 1920. These companies hold more than $500 billion in cash, which is 85% of the total forex reserve held by RBI in 2020. And the net income of these 10 companies is $179 billion, which exceeds the net income of all Indian equities in the portfolio. But these companies are mega companies. These companies are the companies which are leading several mega trends, are pursuing innovation to change our present and our future. And these companies form part of our life today. So why not make them part of our portfolio and enjoy their wealth creation journey? The NYSE FANG+Index is not only about capturing the 10 well-known stocks, the companies which are doing so well. It is also about the returns which these stocks have generated historically. And if you're looking, let's say, at a 5-year data, NYSE FANG+Index has given 46.8% return compared to 28% return which was given by Nasdaq 100 and 17.3% return of Nifty 50 index. The differential is huge. Even if we are looking at 1-year data, NYSE FANG+Index has given a return of 105.3% in last 1 year compared to 55.6% of Nasdaq 100 index and 31.3% of Nifty 50 index. So NYSE FANG+Index has performed very well in past years and has significantly outperformed Nasdaq 100 as well as Nifty 50 index. While I would just like to add that this index is comparatively more volatile than the Nasdaq 100 as well as the Nifty 50 index, and same can be seen in the slide. And if you look at a 5-year data, then FANG+Index volatility is 33% compared to 24% of Nasdaq 100 index and almost 20% of Nifty 50 index. But again, if you are looking at return to risk ratio, which tells you at how much risk, how much of return you are generating, we see that FANG Plus does comparatively well than Nasdaq 100 or Nifty 50 index. Even when looking at the calendar year performance, there are 7 out of 8 calendar years in which FANG Plus index has done better than the Nasdaq 100 index when we are talking about US market. For example, in 2017, the FANG Plus index has given 49% return compared to 25% return of Nasdaq 100 and 30% return of Nifty 50. Even when we are looking at rolling returns. And what do I mean by rolling returns? Rolling returns tell you that if you would have had invested for X years, how much returns would you have generated on an average in a particular investment vehicles. Now let's see what would have happened if you would have invested for 3 years in a FANG Plus index versus for a similar period in a Nasdaq 100 index. If you would have invested for 3 years in FANG Plus index, on an average, you would have generated a return of 36.1% compared to 23.2% which you would have generated from a Nasdaq 100 index, or 15.6% which you would have generated from an S&P 500 index. So from a calendar year point of view, from a rolling return point of view, and even from a CAGR point of view, FANG Plus index seems like a very attractive offering in terms of wealth creation based on historical data. Now, currently, as I mentioned earlier, the index consists of 10 stocks, and these 10 stocks are weighted equally every quarter, and in between the quarter the weightage of the stocks can change depending on the price movement of the respective stocks. For example, we are looking at the Feb end data, and here we can see that Baidu has a weight of 14.4%, Twitter has a weight of 12.1%, and Alphabet has a weight of 11%, whereas other stocks are just below 10%, and that is because Baidu, Twitter, and Alphabet performed relatively well compared to the other stocks, and that is why their weights have increased. So, all in all, NYSE FANG Plus ETF and the fund of fund vehicle provides a very focused exposure to well-known companies, which is changing the world we are living in right now and are geared to change our future also by pursuing so many opportunities across multiple trends which are emerging on the technology side. This particular portfolio has performed very well historically. It has outperformed Nifty 50 and Nasdaq 100 significantly. While the portfolio has higher volatility, the return to risk performance of the NYSE FANG+Index seems reasonable compared to Nasdaq 100 and Nifty 50 index. So an investor who wants to take exposure in this portfolio of FANG Plus stocks can certainly look into investing in either the ETF or the fund of fund depending on his or her preference. The NFO starts on 19th of April for both the ETF as well as the fund of fund. The NFO closes for the ETF on 30th of April, and it closes for the fund of fund on 3rd of May 2021. So the investors can explore possibility of investing in the ETF or the fund of fund based on his or her risk profile and based on the appetite to take exposure in the global markets and to take exposure in these well-known companies which form part of NYSE FANG+Index. That's it from me. Thank you for watching and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.